Hello, this topic is on corporate formation and contribution. Before we consider the respective topic, we have to always ask, what are the general questions that we have to address for any income tax issue? Remember that we must ask, what amount is included in gross income? What amount is deductible? What is the character of the attribute? When is the amount included or deducted? And who must include, deduct, or utilize the amount? When we're considering property transactions, we always have to start with the gateway provision, Section 1001A of the Internal Revenue Code. Section 1001A specifies that the gain from the sale or other disposition of property shall be the excess of the amount realized over the adjusted basis provided in Section 1011 for determining gain. And the loss shall be the excess of the adjusted basis provided in such section over the amount realized. So to state that simply, it's the amount realized minus the adjusted basis gives you the realized gain or loss. Realized gain being if it's a positive number, realized loss if it's a negative number. Now, we have to define some items. What exactly does sale or other disposition mean? What does property mean? What exactly is amount realized, and what is adjusted basis? For many viewers out there, this might be review, but you have to remember that when you're dealing with transfers of property in the corporate context or contributions of property, you always have to start by looking at Section 1001. This applies to any income tax issue. Property is never defined in the Internal Revenue Code or anywhere specifically in the regulations. However, through case law, it's been broadly defined. Sale or other disposition has been defined in the regulations as well as case law. Sale is considered the conversion of property into cash. Other disposition is defined as an exchange of property for other property differing materially either in kind or in extent. Now, all aspects of ownership must be transferred when you're considering sale or other disposition, because this is going to differentiate leases and whatnot. So defining amount realized, which, remember, our formula that we saw on the previous slide is the amount realized, or AR, minus adjusted basis gives us our gain or loss. Now we're having to start in the formula by defining the amount realized. The amount realized can be considered a formula of actual cash received plus constructive cash received plus the fair market value of non-cash property received minus any selling expenses. Actual cash received, that's pretty straightforward. That's when you're actually receiving money or whatnot in an exchange or sale. Constructive cash received, this deals with the relief of a liability. The idea here is that it's constructive cash in the sense that, let's say that you are selling a house that you own, and you're selling it to a buyer for $100,000. The house is worth $500,000, but you have a $400,000 mortgage in the property. The buyer is going to assume or take subject to the mortgage on the property, and they're going to pay you $100,000. Again, they're paying you $100,000 cash, and you're receiving $400,000 of liability relief. This is as if this $400,000 is as if the buyer gave you that $400,000 cash, you turned around and paid your bank, let's say the bank is called Big Boy Bank, and you pay off that liability. This is added to the amount realized because, again, the idea is that they're constructively paying you the money and you're paying off your bank. We also add the fair market value of non-cash property received, and we subtract away any selling expenses. Examples of selling expenses include, if you're selling your house again, paying a realtor. Next part, again, when we're looking at our formula of amount realized minus adjusted basis gives us our realized gain or loss, we have to define, well, what exactly do we mean by adjusted basis? Now, the idea of adjusted basis is a notion that's throughout income tax. When we consider our income tax system and how we're defining income, we have to keep track of what was previously taxed capital. Section 1011 deals with directing you throughout the Internal Revenue Code to various code sections that provide basis rules. Okay? So the actual language, the adjusted basis for determining gain or loss from the sale or other disposition of property, which is section 1001, our formula, right? Our formula, which again I've denoted right here, shall be the basis determined under various sections. You might recall some bases, rules that you learned back in your basic income tax course. You might have learned about cost basis, which is defined under section 1012 as whatever you pay for the cost. In accounting, we have a similar concept with historical cost notion. You might recall that when somebody passes away or they die, there's a rule that says that a party that receives property as a result of a transfer upon death receives the property at fair market value. Okay? The cost basis rule, that's defined in section 1012. The fair market value rule, that's defined in section 1014. There was also a rule, you might recall, special rules dealing with gifts that say that we generally carry over the basis. However, there are some limited exceptions where you use fair market value. We find that in section 1015. So in this course, or I should say, I'm sorry, for this concept, not this course, this concept, the general cost basis is going to be extremely important. So you need to recall that. Again, the idea with cost basis is that whatever you pay, so you buy a laptop computer for $1,000, your basis in that computer is $1,000. So let's consider an example. Patricia sells land to Carol for $1,500 cash and a piece of equipment with an adjusted basis of $15,000 and a fair market value of $20,000. The land was subject to a $25,000 mortgage, which Carol assumed. Patricia incurred $2,500 in selling expenses. Patricia originally purchased the land for $40,000. What is Patricia's realized gain or loss? Whenever we have a property transaction, we should always start by going directly to section 1001, which defines realized gain or loss. And we know that a realized gain or loss, the formula is the amount realized minus the adjusted basis, and that gives us the realized gain or loss. Now, before we apply that, we have to have property, which again is defined broadly. Here, Patricia's selling land, that's property. And we also have to have a sale or exchange. We're told that Patricia sells, so she's selling land for $15,000 cash and a piece of equipment. Not only is Patricia selling in the sense that she's receiving cash, there's an exchange because she's receiving property other than cash that's materially different. So we do have a sale I use the term exchange, other disposition I should say. You can think of it as an exchange. It's like an exchange in the sense they're materially different. Now it's important to note that throughout the code, different sections say sale or exchange. Just because sale or other disposition is defined in section 1001 doesn't mean it necessarily applies to other provisions. Keep that in mind. Let's go ahead and calculate our amount realized. Our amount realized, which again the formula is actual cash received plus constructive cash received plus the fair market value of non-cash property received minus selling expenses. Is Patricia receiving any cash? Yes. Patricia receives $15,000 of actual cash. She also receives a piece of equipment with the fair market value of $20,000. We're going to add in $20,000, the fair market value of the property. Now the land that Patricia is selling is subject to a $25,000 mortgage, which Carol, the other party, the buyer, assumes. That's going to be constructive cash. It's as if Carol is paying Patricia, who's our party here, right? That's who we're considering, Patricia. It's as if Carol is paying Patricia $25,000 cash, and Patricia is turning around and paying off the liability. Next, we have to consider any selling expenses. Patricia incurred $2,500 in selling expenses. Maybe Patricia hired a real estate agent to sell this land. So we subtract away $2,500. When you add all that up and subtract away, you get $57,500 is the amount realized. So now we have to subtract away the adjusted basis. We're told the adjusted basis is Patricia originally purchased the land for $40,000. Now normally we have to worry about various adjustments such as depreciation, but land does not depreciate. It's non-depreciable. We're going to subtract away from the $57,500 the adjusted basis of $40,000, and we get $17,500 as our realized gain. This was the adjusted basis. So that's the realized gain. The next step in the process is to determine the amount that's recognized gain or loss. Section 1001C says, except as otherwise provided, the entire amount of gain or loss on the sale or exchange shall be recognized. So basically, unless there's some other rule in the code, you must recognize the realized gain or loss. What's the difference between realized gain or loss and recognized gain or loss? If you recall, realized gain or loss, when you define gross income in section 61 of the Internal Revenue Code, there's 3 requirements. There must be an accession to wealth, which deals with your net worth increasing. There must be a realization event, and there must be dominion and control. Realized gain or loss is that second component. The realization event is met, usually some triggering event. A sale or other disposition is a triggering event. This is to distinguish various activities where your net worth might increase, but you haven't yet had that realization event. For example, if you own stock in Apple, guess what? After a year or so, the value might go up. Well, if you still own it, but you haven't yet sold it, there's no realization event. You should not have to recognize gross income. But once you sell that stock, let's say the value's gone up, you do have to recognize gain. So that's what the realized gain or loss notion is. There is a realization event. The recognized gain or loss, that's actually what gets reported on the return. The reason that we have this specific provision is that there's special rules in the Internal Revenue Code called Nonrecognition Rules that basically Congress feels that there's times where it's not appropriate to tax certain events. When you consider tax policy, simplicity, equity, efficiency, it makes no sense. Basically, from an efficiency standpoint, we want to make sure the tax laws don't affect certain behavior. They don't de-incentivize certain behavior. That would be bad. To be efficient, we want to make a tax that's not going to change behavior, unless we do want to change certain behavior through social policy. For example, there might be certain energy efficient tax credits. But generally speaking, from an efficiency standpoint, we want to have an elastic tax, meaning it does not affect the behavior of a taxpayer. That's the economic standpoint. Non-recognition rules have that same general theme in mind. Some types of non-recognition rules you might remember from your basic income tax class, or learning about basic income tax, like-kind exchanges, involuntary conversions, maybe transfers through marriage or incident to divorce or separation. Those kind of transactions, it makes no sense because you're basically moving money, your investment has stayed the same. Your investment has not changed. Now note that under non-recognition rules, it's not an exclusion of gain or loss. It's simply a deferral. And the way that we have that is there's always corresponding basis rules, and you're going to have to know those. So let's consider some more transactions. William sold land for $400,000 cash. He purchased the land for $350,000. Well, right there, in that transaction, William has $400,000 amount realized, plus $350,000 adjusted basis, gives us $50,000 of gain. William exchanges his land for Google stock with the fair market value of $400,000. He purchased the land for $350,000. This is going to be the same result. The difference between these two transactions, William has a sale, and under Section 1001 has a realized gain or loss of $50,000. The second transaction, William has an exchange or other disposition. But in both, there's a realized gain or loss. What is the recognized gain or loss out there? Well, I'll tell you right now, there's no provisions in the code with respect to these two examples that allow for non-recognition. Now let's say that William wants to start a hardware store. He contributes $400,000 of land to William Inc. He forms a corporation under state law. Let's say under the state of Florida. He contributes $400,000 worth of land for 100 shares in William Inc. Okay? He purchases the land for $350,000. So William, we'll say W, and we denote individuals, the circle. He's transferring land for stock in William Corporation. W, which is for William Corporation W. So corporations are going to be a rectangle. William transfers $400,000 of land, and in exchange, William Corporation, William Inc., right, transfers 100 shares. This is the only asset that William Inc. now has. So what do you think the value of those shares are? $400,000. If William owns 100%, this is 100% ownership. Before the transaction, right, William owned the land, which was worth $400,000. After the transaction, William owns stock, which is 100% control, which is worth $400,000 because that's the only asset in the corporation. This is an exchange because William, right, this is an exchange or other disposition, which is referred to in section 1001. Why? We have property. The reason that we have other disposition is because William had land and he's exchanging for stock. Those are two materially different assets. But there's just something not right about this. William controls the corporation. Yes, he's transferring the land. And yes, William Corporation is a separate legal entity under law. But William controls it. The next day, William could decide, you know what? I made a bad decision. I don't want to form the corporation. I don't want it to be around anymore. I'm going to dissolve the corporation. I'm going to transfer the land back to me. From an economic standpoint, this doesn't make sense. For our section 1001 analysis, we must do our amount realized minus our adjusted basis. The amount realized is the value of whatever William's receiving under Philadelphia Park and Amusement and under regulation 1.1001-2. 1 and 2. The amount realized is the 100 shares, which is $400,000. I'll put 400K. 400,000. Minus the adjusted basis of the property given up, which is the land. That's $350,000. That's a $50,000 realized gain. If you go back to examples 2 and 3, you'll notice that we had a $50,000 gain there and it had to be recognized. Here, though, William is simply moving money from one pocket to the other. What do I mean? Well, before the transaction, William had the land. After the transaction, William has stock, but he controls the corporation that owns the land, and he could easily transfer it back to him because he has control of the corporation. We'll learn what control is later under the law, but he has control. Guess what? This $50,000 realized gain, 0 is recognized. Okay? Now, $50,000 is what we're going to call as lurking gain because you're going to see the basis of the stock is going to reflect that, and you'll see that later on. Section 351 says no gain or loss shall be recognized if property is transferred to a corporation by one or more persons solely in exchange for stock in such corporation, and immediately after the exchange, such person or persons are in control as defined in section 368C of the corporation. This basically applies to William. It says, William, you're not going to have to recognize gain in that transaction. The policy is the same policy that we talked about of non-recognition. The transaction does not close the transferor's investment with sufficient economic finality to justify reckoning up the transferor's gain or loss on the transfer property. All that's really happened is that ownership has changed in form. William owned the land before, William owns the land after, because he controls the corporation. So it's more like, think about it indirectly. Bicker and Eustace, by the way, is a treatise that we look at within the corporate tax area. Overall, this is good policy because it encourages business investment. Think about it. If we didn't have this rule in play, this transaction would disincentivize many taxpayers from forming a corporation and transferring property because they would have to recognize gain or loss. Okay? Could create potential tax, yet there's no money to pay it because all that simply happened is William had land after William owned stock. Does William actually get cash? No. To pay the taxes? No. And again, from an economic standpoint, William still owns the same thing. Now, this provision is extremely important because this is happening as we speak. Contributions and formation of corporations are happening as we speak. It happens millions of times a day. Well, in 1909, Congress enacted an excise tax on corporations. 1913, we have our income tax. And guess what? The corporate income tax rolls over. 1918, we see a provision just like we see with 351, the current law as it stands. There's a little bit of difference. In 1918, this is what it looks like. In 1921, Congress clarified the issue. And this is what it looks like in that provision. And guess what? You see that 80% test of the control. You see that now we're talking about various other types of transfers, basically lumped all together. In 1924, it gets more limited. 1954 is when we actually have the provision in the code, just like you see pretty much today. I've underlined the areas that they're not specifically in the code today, but they're still relevant. So it says stock or securities. The or securities was removed, but it still applies. The last sentence was also removed. For purposes of this section, stock or securities issued for services shall not be considered as issued in return for property. That still is the case. This applies to property, not services. Just like we talked about with section 1001, the definition of property, property is also defined, or is also in section 351, and we have to define that as well. Doesn't apply to services. Here is the current code again. No gain or loss shall be recognized if transfer of property to a corporation by one or more persons, that's the first criteria that we have to meet, solely in exchange for stock in such corporation, that's the second, and third, and immediately after the exchange, such person or persons are in control, which is defined in 368C of the corporation. Now, I've underlined some key words because all of those have their own definitions. We're going to go through all three of these criteria. Now, this is going to be a checklist approach. You must meet all three to get section 351 non-recognition treatment. Which, remember, non-recognition is going to be important because, generally speaking, in income tax, one of the themes is that taxpayers prefer to defer income recognition and accelerate loss in terms of deductions, or they prefer to take deductions as soon as possible because of time value of money. Checklist approach is the best way to approach this because you're going to see that those three criteria must be met. So if we go through those three criteria, you're going to see various issues that come